In this presentation, we will be taking a look at multiple choice questions related to merchandising company. For more accounting information and accounting courses, visit our website at accountinginstruction.info. First question. Beginning inventory plus net purchases is A. Gross margin, B. Net receivables, C. Ending inventory, D. Net income, or E. Goods available for sale. So once again, we're going to say that beginning inventory plus net purchases is what? It's going to be some type of calculation. Beginning inventory plus purchases. Gross margin. And if we start to think about these, we probably want to go through this and think if we can think of the calculation for each of these transactions, or possibly think of the calculation, of course, that would be resulting first of this transaction, and then see if we can find it in the answers here. So gross margin is going to be the difference between what our sales price is and what we are charging for it. That's going to be the margin that we're getting on it. So beginning inventory plus purchases doesn't sound like gross margin. Net receivables, that's going to be the accounts receivable minus the allowance account. And this might be something you haven't seen yet. We might not have seen net receivables, but you can probably think, well, it doesn't have much to do with inventory, so it doesn't look like it. So I'm going to cross that out with the process of elimination. Ending inventory, beginning inventory plus purchases, we might think, that seems like kind of on the right track there. So that might be something we leave for a second. And then net income, inventory plus purchases. We don't see anything related to income unless it's doing something kind of funny. These are two income statement accounts, and it's going to get to something. I mean, these are two balance sheet type of accounts, or inventory is a balance sheet type of account. Net income is an income account. So unless we're kind of backing into it, that doesn't seem quite right. And then goods available for sale. So I'm going to leave that one for now. We got the C and the E. Beginning inventory plus net purchases is either C, ending inventory, or E, goods available for sale. Now when we see this, we really want to start to recognize this as the cost of goods sold type of calculation. So we're trying to get to, I would think of it as all in one calculation. The cost of goods sold calculation is going to be the beginning inventory plus what we purchased, and then there's a subcategory which will be goods available for sale. That's going to be goods available for sale minus ending inventory would get to the cost of goods sold. So what we really want to do when we approach some problem like this, I wouldn't try to memorize it as two kind of calculations. I wouldn't try to memorize it as a goods available for sale calculation followed by the cost of goods sold calculation. It should all be, I would think, one type of calculation that you can plug any type of problem into. So it's going to be, if you have beginning inventory, this is going to be terribly written, plus purchases is going to be this, goods available for sale, minus this, ending inventory, will give us costs of goods sold. So you want to have that down because there's going to be, you can ask any question within this type of calculation. Here we did it with words, asking for this component. If you just know if you just memorize this entire calculation, you will be able to get that component. If they ask for the calculation of any of these components, they can give you this number, this number, this number, and just leave you with one number that you don't have. What you don't want to do is remember 10 different calculations to try to figure out the one number that's not here, meaning reorder this in order to solve for each component. What you want to do is just fill out this equation and just leave the missing component there and then solve for it. So that's going to be the first one. Next question. Which is not true of gross profit? A, can also be called gross margin. B, net income calculation includes gross profit. C, gross profit is calculated on the single-step income statement. D, equals net sales less cost of goods sold. So let's go through those one more time, crossing out using process of elimination. Question once again. Which is not true of gross profit? A, can also be called gross margin. That's actually true, so that sounds good. B, net income calculation includes gross profit. So you might not really understand that one right off the bat, so I'm going to leave that for now. C, gross profit is calculated on the single step income statement. So in that one, we have to figure out what is a single step income statement, and is it different than a normal income statement? I'll go back to that one. And then D equals net sales less cost of goods sold. Net sales less cost of goods sold is the gross profit calculation, so that's going to be true. And of course, when we think about this, we do want to think first, of course, what is the gross profit calculation? So that probably is the thing you want to calculate in your mind first before we should even read through these, and that'll help us to process these out and then just look for the correct answer. So the gross profit calculation is net sales. Whenever you see the term net sales, remember that doesn't mean net income. Don't get those two mixed up. Net sales is just going to be the sales or the revenue minus those two kind of contra accounts, which is sales returns and allowances and discounts. So this is really, net sales is really sales after these contra accounts, which are really just decreasing or negating the sales that didn't really happen. So net sales is just really sales minus the cost of goods sold, and that's going to give us the gross profit. This relationship really hugely important if we are a merchandiser. Therefore, we break it out separately in a multi-step income statement. And so if we read through this again, which is not true of gross profit, we're left with B and C, B being net income calculation includes gross profit. Now, if we're on a multi-step income statement, that's true. It's one of the components on the way to net income. We have the gross profit calculation, and then gross profit minus everything else gives us net income. So I'm going to say that's not it. It's got to be C here, which says gross profit is calculated on a single-step income statement. So why is that not true? Well, it has something to do with the single-step income statement. And remember, single step as compared to a multi-step income statement. A single step we can think of usually would happen, a service company kind of uses more of a single step income statement just because they don't have the components typically used in a multi-step income statement. Meaning they don't have merchandise, and therefore they don't have cost of goods sold. So all the expenses we can think of being grouped in one category. We can do that same type of thing for a merchandising company, grouping all expenses, including cost of goods sold, into one category, into a single-step income statement, providing much less information. But if we do that, of course, we don't have the subcategory of gross profit. So gross profit is not calculated on a single-step income statement. It would be used on the income statement most often seen for a merchandising company, one that sells inventory. That is a multi-step income statement. So once again, answer will be question, which is not true of gross profit? C, gross profit is calculated on the single-step income statement. Next question. One period's ending inventory is A, always 0, B, the next period's beginning inventory, C, the prior period's beginning inventory, D, is overstated, E, always the same as beginning inventory. Once again, reading through this, one period's ending inventory is process of elimination. See if we can see which of these we can get rid of. It will be A, always 0. Now, one period's ending inventory. Now, that one could be referring to the temporary closing process. If we close something out, then we're left with 0 at something after the closing process. But one, it doesn't indicate the closing process really here, and two, it's a permanent account. It's an inventory, it's an asset, so it doesn't go down to 0. Only income statement accounts, revenue and expense, draws or dividends will go down to 0. Permanent accounts will not. So I'm going to say that doesn't sound right. B says the next period's beginning inventory. So one period's ending inventory is the next period's beginning inventory. That sounds reasonable to me. I would think that sounds fairly reasonable. I'm going to leave that one for now. Then C says the prior period's beginning inventory. So one period's ending inventories. The question is, the answer, the prior period's beginning inventory. That seems kind of backwards, right? If it's the ending inventory of one period, it's not going to be the prior period's beginning inventory. It might be the prior period's ending inventory. So this one doesn't sound right to me. And then the next one, D, says is overstated. One period's ending inventory is overstated. I don't know how exactly we would know that from the question, so that seems like that doesn't quite apply. And then the last one period's ending inventory is, E, always the same as beginning inventory. So we're going to say the ending inventory is always the same as beginning inventory. Again, that doesn't sound quite right. I would think it would change from the time period. So we're left with B here. And so if we take a look at the question and answer one more time, one period's ending inventory is B, the next period's beginning inventory. For more accounting information and accounting courses, visit our website at accountinginstruction.info.